Hello everyone, welcome to Why Most Traders Lose and What You Can Do About It. So, nice to be with you on this Saturday. Welcome to you as you are connecting from all over the world. Market is now closed, meaning for us less stressed, but still, it is about our learning curve by always trying to get better. So why did I wanted to do this webinar? I wanted to do this webinar as recently I came across many people who told me about their recent experience, trading experience. Those people experience big losses. So here, the whole idea of this webinar is not about, blaming the brokers, blaming the gurus, blaming Twitter, blaming the world, but it is trying to find solutions. Why? Because investing at the end requires to be committed, and there is no magic formula. So to make it clear, excuse me first if I might sound a bit boring over the next 30 minutes or so, but I think without understanding those basics, you'll be struggling with a portfolio. So quickly, I want to give you a quick background of what I've been doing for the last 20 years. Before working in Paris as a cash equity trader in 2000 to 2004, I made several internships where the idea was to get access to the industry. So today I have many people, young people, coming to me and say, Greg, it's almost impossible to have access to the industry. I'm really struggling. If you want to, it's possible, but you have to make sacrifice. You need to push hard. And for 12 months, I did an internship with a very low salary. So that was 20 years ago. Since then, jobs have been cut. So if you want to have a job, you need to push hard. Then from 2004 to 2008, I ran both a long-only fund and a long-short fund where I was part of two teams. And during that time, the asset under management went from 150 million euros to 600 million euros. From 2009 to 2018, I was in London, and I'm still in London, where I was doing proprietary trading at Infinity Capital Markets, and where my mandate was an absolute return mandate, with no asset and regions constraint. In the meantime, since 2014, I have been mentoring many people around the world. So let's talk about the numbers and why we could be struggling. So if you are on this webinar, that is because you know the odds for retail traders to be making money are very small. So we know this number that is 70 to 90% of the retail traders do lose money, and most of the time actually in a very short-term period. Second thing is, despite all those warnings, even if those warnings are not always there, if we are looking at trading, we think and we hope that for us it will be different. So I remember I think it was 1999, 2000, yeah. I was doing this internship for a broker in Paris, and that was the end of the internet bubble. And I thought, that was different. I knew something, because I was helping these brokers. And I was sitting on the floor, and during the internship, I heard, about a stock, very hot stock in France. So I bought that one. And what happened? 1 month down the line, I had a margin call. Why? Because I knew nothing. So what happened here? The P&L did the talking, and this is where my pain or your pain could come very quickly. So what I want to be saying here is literally I discovered in 2014 the world of retail trading. Okay, so when you're working for a hedge fund, when you're working as a prop trader, you 200% concentrated on your P&L, and you don't even think that someone in the US, someone in Europe has a small account and can be making or losing money. But for the last 5 years, I had so many people coming to me And what is really shocking is the amount of money they are losing across asset classes. So I can give you several examples. I had recently one very nice person in Australia came to me and said, Greg, I bought Bitcoin at 1800 and 18,000 actually, should I be saying. And since then I've been holding the position. And so that means what? At one stage he was losing 80%. The second one, it's important to realize that yes, we all have dreams somewhere. And yes, trading in that sense could be considered as being an easiest way to be making money. So what we need already to underline here, on the one hand, we get expectations, which is I want to be making money quickly, easily. And on the other hand, the reality, which are the facts, which are the fact that 80% of retail traders are losing money. So in that sense, this is why trading is so compelling and so brutal at the same time. As why? Because we can't be hiding from our P&L. And again, when I look at those numbers of those losses, it is extremely, extremely shocking. So why most traders are losing money? The first thing is, from my experience, they have unrealistic expectations. And here we will have to be looking at what are the expected returns versus the historical returns. So we're going to take in the next slide and next minutes, when we're going to go and move into an Excel spreadsheet, be looking at the expected returns for the S&P and the euro dollar and what kind of return we could be expecting. The second point where I think people are struggling is when people believe that they have a process, but in reality, there is none. So the question we should be asking ourselves before putting any money at work is, which process are we following to generate ideas? Then to move those ideas into trades. So the downside of the last 20 years is you get too much information. So 20 years ago, when I had to buy a book on finance, technical analysis book, I had to cross literally for 45 minutes to go from one place to another place in Paris. And if I were lucky, I will find a book. Now you have millions of books. You get Twitter, you get Facebook, you get gurus everywhere. But that doesn't mean that having information gives you a process. And I think the third point that is extremely important, and to me, which is, as long as you have it, you're going to be safe, is in reality, those 80-90% traders do not have risk management. And when we are talking about risk management, we are talking about having concentration limit, leverage limit, stop loss, risk reward, all those things. So to give you an example, that will be like if you were driving a Ferrari in the Nürburgring without an helmet, seat belts, or even worse, no brakes. So yes, maybe you're gonna enjoy it for 2-3 minutes, but second or third corner, you'll go offside. So what we have is, for most traders, is they are missing all those 3 points. That doesn't mean that, as retail traders, you are just doomed and you can't be making money. I think what is key is to be guided and finding a trend, finding someone or a process that will gonna help you. So if we take again the losses, because I think it's important always to give example. Recently I had another mentee, so we just finished the program, and in 2015 he came into the market. How did he do that? He was just reading a newspaper and he saw a news on an E&P company, an E&P stock. E&P stands for exploration and production. And based on that news, he decided to put £5,000 or dollar into that stock. So that was 100% of the money he wanted to allocate to stocks. And guess what? In the same year, in 2015, oil went from 125 to 25. And I think his company actually went into some local problem because it was somewhere in Africa. So the stock went down 60-70%. So why and how was the process? The process was reading the newspaper. The second one, which actually happened very, very often, is people are coming to me and say, look, what is your process? What do you offer? How can I learn something? And I'm pretty open, I know it works. I tell them, I've been working for X years in the industry. I've been doing this and this. I've been running different kind of strategies and different books, long, short. And then I ask them, what about you? First is like, I'm a bit struggling, but I'm fine. Then, it takes time for people to really tell you the truth. And most of the time, what they're going to tell you is first, they spend between $3,000 to $5,000 to go into a 2-day seminar somewhere in the US, in the UK, in Australia, where they're going to learn 2 things about technical analysis. Then, after wasting those $5,000, they're going to waste another $5,000 using this metrics or this kind of process, which is not a process, leverage big time. And after 3 months, they went from having $10,000 to zero. And on the other hand, they will tell me, look, Greg, if I have to go and do your process, it's going to cost me first money and a lot of time. So guess what? I know from experience that all those people, in 6, 12, 18 months down the line, they will come back at me. And some of you will say from day one, so actually, yes, he's probably right. And some of you will learn from experience and they will come back at me in 12 months time. So the example of the NP, the Bitcoin, buying $5,000 so-called courses or seminar just doesn't work. So, and that can be true as well. I think that will be probably the last example that I'll be using is for people, that start, and let's say that they do have a lucky start. So they have $10,000 and they are up 25% after 2 to 3 months. They have absolutely no idea what they are doing. And then they give back all of what they made. And most of the time, they will lose more. So here, you don't need to go through this whole process to be losing money big time to actually go for proper education. If you want to learn to play tennis, if you want to learn to play golf, if you want to learn to drive, you're going to learn from professionals. And if you don't do it, if you don't have a process, and you have absolutely no chance. So all those stories, to give you a picture, obviously went from $500 to $250,000 or £250,000. So we are talking big money. And it's not only about the money, it's the size of your capital that you're using or you're destroying or you could be destroying. And what I want to be helping here is literally avoid all those mistakes. Again, if you are listening to that webinar, I know that this is something that you want to avoid. So let's look at, I think, the most important first thing where people are struggling is having unrealistic expectations. And when I say unrealistic expectations, it's not only in trading, Again, if you start to play tennis, you think that your backhand, your forehand is going to be hopefully very good in 2 weeks' time. Then you might be struggling. The learning curve could be long. So anything about the learning curve is the same here. The problem with trading, and this is the biggest problem, is when we do something wrong, we are losing money. If you play with your iPad, you're just wasting time. So that means, yes, some will argue wasting time, is wasting money. But at the end of the day, the worst thing about trading when it goes wrong is you are losing money. So what we should not be doing is believing the hype, and we should be looking at facts. And again, that can sound extremely boring, but that is extremely true. The problem is most people will go the other way around. And at the end of the day, they will get caught by the fact, which is very often ending up with big losses. I don't want to be in a doom and gloom situation. I don't want to be telling you, you're never going to make money. It's not going to happen. I know that you could be making money. When I do the mentoring program, people come to me, they have quite low confidence. They think that, they need a magic formula, that there is something special. And through the whole process, step by step, we are ticking the boxes, and at the end of the day, they have a process, they have confidence, and they are coming back to me and say, look, Greg, actually that's easy. Everything makes sense. So what we should be doing here regarding those unrealistic expectations. First, we should be comparing the returns between the asset classes and inside those asset classes. Then, that is really Finance 101, and for most of you, hopefully, that should ring a bell. We should be comparing our time frame with historical return. So that is something that we're going to do when we're going to jump into Excel. The third point, I think, again, you need to be very factual, and I strongly advise you to be building your framework, your own database. And for that, getting all the data from websites like Yahoo Finance on investing and downloading and looking at the returns through an Excel spreadsheet is very easy. Finally, I think it is about thinking about the long-term capital appreciation. So what we want to be doing when we look at unrealistic expectations is the returns of the different asset classes over time. So we should be looking at the 5 asset classes: stocks, FX, bonds, commodities, and money market. Yes, you will not be necessarily trading all of them, even if that should be better in terms of diversification, but you should be aware of what is happening. And actually, the recent moves in the repo market in the US over the last couple of weeks is a good indication of the expectations, upside and downside. The second point, which is the time frame, compare your time frame with historical returns. This is something that we will be covering in the next Excel spreadsheet. The third point, play around with Excel spreadsheet. Again, I strongly advise you to be building your own database, your own framework, because that will give you first confidence, understanding, and a way of generating idea. The first point, we have to understand that 1 month's P&L is not a trend. So I'm with you. I've been sitting in a trading room for years where you could be struggling on one day, you can be struggling for a month, for a quarter, and it's hard. And it's even harder because at the end of the day, we are most of the time comparing ourselves with someone else. So when I joined the prop trading company here in London, prop trading was a bit different and is still different from running a book at a hedge fund. So that means the time frames, the concentrations are different. And I was sitting next to those guys, and those guys were more experienced than me, and they were making more money than me. And every day I was coming back home and I was like, they are just too good, I'm never gonna make it. And I stayed there for 10 years. And when I was there, I had one of the best Sharpe ratio of the trading room. That doesn't mean I was the best. That just meant that you need to understand that it takes time from your learning curve. And you have to go step by step. If after the first month I was thinking, okay, this is it, you don't make it. So think about long term and not about 1 month or 1 year. So now I'm going to go, before going into Excel, looking at the performance of the different asset classes and the expected returns. So here we get some of the performance of those assets from 2007 to 2018, and you need to understand how much you could be making based on historical returns. So as you know, probably some of you, the market is really impacted by the economic cycle and where we are in the economic cycles, and depending where we are in the economic cycles, the performance of those assets will be very different. So if we look at 2007, so let me grab this. So if we look at 2007, that was the end of the economic cycle in the US. Still, the economy was, even if it was slowing, was still doing okay. And you can see that the risk-on emerging market did very well. Commodities in the late cycle did well. Bonds were doing okay. REITs, which was the first warning, went down 17%. So in early or during 2007, you could early see that something was wrong in the US. Again, here the idea is not doing some back trading, but it's to give you the picture. Then when you go into recession, everything that is risk on goes risk off. Mid cap, large cap, REITs, international stocks, emerging market, everything is down except the bond and obviously the gold, the cash, and so forth. Then, so that's the recession in 2008. Then in 2009, you get the recovery. Recovery, risk on, boom, 69% for emerging market. Then we got small cap, 41%. And in the contrary, bonds, only up 3%. And you can go and on and on and on. Same here, if you look at 2013, where the economy is doing very well in the US, small cap do very well. Large cap, same. So as we know, small cap most of the time will be outperforming large caps in the long run. But emerging market were rubbish. Bonds were really bad. And commodities, same. So always look at the returns, your expected returns versus historical returns. So let's jump now into Excel. Okay, let's jump into Excel, and where I want to give you example of two expected returns or two historical returns. First, I want to be starting with the euro dollar. So I look at the euro dollar and looked at the monthly return since 2009. So I did like a simple return, monthly return, 3 months return, and 6 months return. And I used absolute return to see, if you were always right on picking the good side, meaning, you go long, you go short. So when it's up, you're long. When you go down, you were short. So on a monthly basis, if you are trading the euro dollar, meaning you are putting one position and closing it in a month's time, you will have been making 2%. If you are doing the same on a 3 months basis, that will have mean 3.4%. 6 months basis, 4.9%. So now imagine that your target is to be making 20% every year. So 20% every year means what? If you're trading on a 1 month time frame, you need to be right 10 times, and 100% of your position will be in euro dollar. So 100% concentration and being right 10 times in a row. So what are the odds of you being right 10 times in a row? That's the first question. Otherwise, you need to be right only once, but you need to be leveraged 10 times. So now you have the odds. The second one is looking at the 3 months. So we do the same, 3 months, where the average absolute return is 3.4%. So to end up with 20% yearly return, you need to be right 6 times in a row. Okay, 6 times, but times a quarter, that gives you a year and a half, and be 6 times leverage, or be 6 times leverage on the trade. Same for the 6 months, we have roughly 5% return, meaning either we are right 4 times in a row, so almost 2 years, which is not really in line with our 1 year target, or be leveraged 4 times only once. And here you can see that the max return was 7.5% and the minimum return 0%. So let's do the same now with the S&P 500. So euro dollar 2%, 3.4%, 4.9%. S&P 2.9%, 4.9%, 7%. So all the returns are up by 50% versus the euro dollar. So by definition, the 10 times for the 1 month goes to 6, 4, and 3. But what you have here is a max that is higher, even, and the minimum is similar. So yes, you have higher returns, but when we're talking about returns, we need to think about risk adjusted. What does that mean? That means we can have higher returns with the S&P than trading the euro dollar, but we are taking higher risks. So don't look only at the historical returns, but you need to be looking at returns adjusted from risk. Okay, so here we are in a camp that if we are targeting 5, 10, 15, 20%, and we are trading one asset or one stock, what are the historical returns of this stock, of this asset, over the time frame that we are looking at? If we are looking at something where we want to be making 20% in a year with 100% correlation, but that thing historically has been moving at best by 10% every year, it's just impossible. Otherwise, we'll have to adjust and be carrying more risk by increasing our concentration. So I wanted to give you something that is similar to what I've been building in the 4x4 video series that will be released next week, is for you to understand versus the capital you're putting, what kind of returns you could be expecting. So I looked at 2 scenarios. The first scenario is if you are in the US, where you could be using 2 times leverage. So if we have $10,000, in reality, we can have what we call a gross exposure of $20,000. If we have a $20,000 gross exposure, in reality, that means we can go long $10,000 and $10,000 short. So based on that, if we are using this $10,000 and we have a 5% return, after year 10, we will end up with roughly $16,000. With a 10% return, that is $25,000. 15%, $40,000. $61,000 for 20% return. So that's the scenario number 1, which is for all the people that are listening to us today in the US. Let's jump now in the second scenario, which is we are in Europe, where the ESMA, which is the European regulator, allows us to do 4 times leverage, 5 times leverage. But in reality, most brokers will offer 4 times leverage. If we get 4 times leverage, we get the ability of having a gross exposure of $40,000. But in reality, you should be thinking about gross exposure of being your long versus your short, and the 2 should be equal. So here we get a net long of 20 versus 20. So if we do 5% return, this is where we're going to end up in 10 years. So we're going to be instead of having 10,000 now, we're going to have 25,000 in year 10, 61,000 in with a 10% return, and almost 300,000 if we get a 20% return. So, but here we need to be thinking a bit differently from the US, because what we have is, yes, we look at 5% return on our limit, but that means on the capital, that will be 10% return. The 10% return on your limits equals 20% on your capital. So let's try to compare now those returns with the superheroes of this world are doing. And when I say superheroes, I'm going to give you 4 examples of people that have been doing good money over the years. So the first one, everyone knows him, is Warren Buffett. So Warren Buffett, since the inception, has been making 20% year on year, okay, annualized. The thing is, some people will argue that he is a long only and he's just following the S&P. It doesn't matter. He has been doing 20% since inception. So that gives you Warren Buffett here. Warren Buffett will be in 20% here. If you take Ray Dalio, which is another decent fund manager, you will have 12% since the inception. For Dan Loeb, 16%, and for David Taper, 25%. So what you have is, those are the returns on the capital. So we need to take into account, and we need to remember that those people that are running hedge fund are using leverage. So after leverage, they are making those returns. So if we think that as starters, as rookie, we might be doing as good as them already, this is quite an achievement. So if we do as good as them, if we do 15 to 20% return on our capital, we should be here. So that's what we could be targeting. Is it realistic to start and think I'm going to be doing this 15% plus return on, or 30% on my capital, or 40%? I think if you start like this, you stand very little chances. So what you have here is, you need to be looking at 2 expectations that you might have. The expectation on the returns of each asset versus history, and importantly as well, the returns you could have on your book. So I love when people are saying, it's about compounding your money, and I'm looking at 40 years and this is what I'm going to do. Trust me, to be making money years after years consistently, we are talking 15-20% plus, is extremely hard. What you really want to be best first is limiting your downside. So work first on not losing too much. I like the 5% to 10% hard stop loss, both on a position monthly from drawdown, and then you build from that. And trust me, if you do the other way around, that means you're going to lose much more, and you're going to destroy your confidence and destroy your process. So let's go back into the PowerPoint, where we're going to be discussing now the process. So when we look at the market, and this is the beauty of the market, there will always be a part of unknown. So if you think, and if we believe that at one stage there is some free lunch, or it's easy to be making money, and there are some strategies that are just giving us money, it never happens. And here, what I want to be saying is, I've been trading from literally 1 minute to 2 years, 3 years, 4 years. And depending on your time frame, you could think that, okay, actually, I don't need this and this, because I don't need to be looking at fundamentals, because it's very short term. Even when you are trading short term, you should be understanding the fundamentals. So over all those years, what I learned is, when I started, I mostly look at the price action. So I look at going up and down. I remember I was looking at the NASDAQ, so I had a screening of NASDAQ prices. And when everything was screening green, I was just buying stocks in Europe. And when it was flashing red, I was just selling. And that was the way I was doing my trading. And I knew nothing. I knew nothing about, anything. What you want to have is a process. And this process needs to have different steps. That means macro analysis, micro analysis, technical analysis, price action, and risk management. What you need to figure out is a process is about ticking a list of different boxes. And if you are missing some of them, and that means you are reducing the odds. And actually, very often, when you are reducing the odds, you know by definition that you're doing it. And what I'm trying to say is, it is obvious when we are missing a point and we say, oh, it doesn't matter, I go for the trade. And I'm going to give you an example that I think works very well. And this is an example that I use when I do the mentoring program. So when we look at the step of doing the fundamental analysis, I said to my mentees, we don't want to be the best analyst in the world. What we want to be trying to figure out is if the numbers make sense. And I give them the example of buying a house. Imagine you come to me and say, I want to be buying a house in London. And I give you a picture of a house and I say, okay, this is worth £2 million. And I tell you, buy it or not, buy it on the picture. Obviously, you will not buy it. What you're going to do is you're going to come, you're going to go into the house, you're going to be checking the floors, the ceiling, the plumbing, you're going to be checking the price of the houses in the street, in the neighborhood. You're going to try to be figuring out, even if it's hard today with Brexit, how England is doing, UK is doing. And you have to make fundamental analysis. So why, when you're putting money for buying a house, you're not doing the similar process when you're buying a stock, doing FX, buying commodities? That sounds obvious now, but literally we need to be careful. So the second reason here why retail traders and most traders are not making money is when they don't have an investment process. The beauty of being a retail trader is you have an absolute mandate. So you don't have any region constraint and asset constraint. So you can be trading whatever you want, whatever the time frame, whatever asset. When you are a value fund manager, when you are a growth fund manager, when you are a dividend yield manager, you have to tick and follow some boxes. Still, they have a process. Those people, even if their mandate is defined on 1 to 2 assets, they do have like a process. So think about this, the difference between the people that are failing and the people that are making money is having a process. If we are just betting or even not following all the required steps of the process, we don't have zero chance. So here I'm going to use 2 examples. The first one is just, I think it's a funny one, which is the Tesla one. And the second one is about M&A. So the Tesla one, probably some of you remember the tweet that was in August 2018 from Elon Musk. So Elon Musk, the CEO of Tesla, and he came and said, I'm considering taking Tesla private at 420, funding secured. So funding secured, the stock went up, all the shorts had to be covered, and since then the stock is down 40-50%. If your process is only to be believing Elon Musk that the company is going to go private, you can tell that it doesn't work. And you could think that it's quite scary that a CEO of a US listed companies could be misleading people. So that tells you that when you look at Tesla, it doesn't matter about your time frame. You need to know the fundamentals. You need to know that actually taking Tesla private is a pretty hard call because they had some debt, because the free cash flow generation was pretty low, because it's going to take some time for them to be generating some cash. Okay, so always think, what is my process? Why am I buying or selling that stock? So the second example is looking at M&A. if you were working in this industry for the last 20 years, you know that there are cycles, and M&A is following those cycles. So I remember when I was working for a hedge fund in 2007, there was this guy running part of the portfolio into M&A. And all he was doing is buying some stocks where we had so-called secured deals. Well, actually, the deal is announced, and normally the deal should not fail. So your upside is to make 2, 3, 4% or less when the deal is closing, and your downside is obviously if the deal is failing 10, 20%, and it goes back to where it was before the announcement. And every 6, 12, 18 months, at that time, you had a sell-off in the market. And when you had a sell-off in the market, all those deals, suddenly all the spread goes very wide. And your book, instead of you making 50 bips every month, you are losing 5%, 10% on the month, and you need to cut. And actually, exactly the same happened in 2008. So that was in the fall 2008. I was sitting to this guy running a book that was for prop trading. I was next to him. He was running a book, and same thing, M&A. It was September, I think, 2009. Many position, first month, down 10%. Second month, down 10%. He had to cut everything. And that tells you that even for the pro, when they have a process, it goes horrible. And that tells you about one thing, which is important, that we're going to cover later, is about the risk management. So the question, we should be asking ourselves many questions when we look at our so-called process. What is my ID? How did I generate this ID? Is my ID a trade? What return could I expect from this trade? What is the investment time frame? What is the trade's risk reward? How much capital should I allocate to the strategy? Is my downside limited? So what I want you to have here, and this is, I think, the beauty, or that should be the beauty of your process. Keep it simple. If you don't understand some part of the process, that means you don't have a process. And again, investing should be very easy. So on the one hand, you get your so-called process, and on the other hand, when it doesn't work, we can be blaming the market. We can be blaming Trump, the Democrats. We can be blaming a guy on Twitter. Or, when I started trading 10 years ago in London at this prop shop, that will be someone making more money than me. At the end of the day, the market does not care about us, does not care about our P&L, does not care about our positioning, unless we are huge. But that just means that we are in denial. Why? Because we are losing money. And it's actually when we are losing money, we should not be in denial. P&L does the talking. So P&L does not lie. Here, I want to help you, and I want to give you some tools that I'm using. I find it extremely useful to go through my trades. So when I was actively trading for a prop trading shop every day, and that was the same for when I was for a hedge fund or a long only fund, every day I was inputting my trades in my own database, in my own portfolio. Why? Because I wanted to understand what was my process when I was buying or selling. The second thing is you want to be looking, obviously, at where you're winning and where you're losing. So that's my winners versus my losers. And you don't want to be just putting the numbers on an Excel spreadsheet and saying, okay, I've been making $500 on gold, I've been losing $200 on euro dollar, and then you close the spreadsheet and you go away. You need to understand why you're making money and why you're losing money. If you don't reflect on your trades, honestly, you stand zero chance. That we can already find the deal now. If you don't reflect on your winners and your losers, you have zero chance. So based on that, you'll be able to see which strategy is working for you. And it can be due to market condition or good timing, or actually your ability to dealing with those strategies. You know, for instance, by definition, by nature, I'm much better at trading some French stocks than some Spanish stocks where I have less knowledge. And that means I'm more keen on putting some risk. I can deal more easily with risks. Some people will tell you that actually I saw a tweet this week about this guy. He's telling you that in FX he's making money, and each time he's trading the S&P future, he's losing money. And that is important to know by facts where and how you're making money. In that sense, what you could be doing is having a trading journal and again manually keeping a record of your trades, and trust me, those two things are very beneficial. So you need to follow the process, and to follow the process you need two core things to understand. First, you always need to understand where we are in the macroeconomic environment. That means where we are in the economic cycle. And the second thing, what are the market's conditions? So you need to try as much as possible. Look, you're never going to be 100% right 100% of the time, but you need to try as much as possible to make the connection between macroeconomic environment and market conditions. Then, which assets, regions should benefit from our analysis? And here we need to evaluate what we should be overweight or underweight in our portfolio. Here, when we look at stocks ID generation, we should be splitting the process into, and I'm talking stocks here. First, you will start with quantitative analysis. Then you want to make sure that those numbers are right, so you'll be looking at qualitative analysis. From those two, what you want to be trying is putting those IDs into a watch list. From this watch list, what is key to understand and why most retail traders are failing is they literally move their IDs very quickly into a trade. An ID is not necessarily a trade, and that is the struggle. So we should be using technical analysis, price action, and risk management. And what I find really helpful here is the P&L doesn't lie. So very quickly you can tell if you're right or wrong. So I'm amazed when I do the mentoring program, especially when I do the first session. My mentees are mostly listening during the first session, and they are telling me, oh, actually, Greg, at the end of the session, it sounds, everything makes sense. Look, I've been watching those videos, all those things, and actually, this is so simple when you say it. And this is why the process works. What you don't want to be doing, and what you might have been doing, is forcing the trade. So you don't want to be forcing the trade, and you want to be at the same time building your own infrastructure. And I think this is key for any retail trader, for any trader, to be building your infrastructure. If you are a professional, you're spending long time on doing your 6 screens with your Bloomberg, of putting all your Excel spreadsheet with live prices, with the API. It takes a long time. You don't go on the first day and you put in position. Why you want to do that? Because you want to grow your confidence. And when you know that you have a process, actually you feel much confident and you can start to put position. For me, the struggle always comes when I'm not following the process. When I know somewhere, sorry for my English, but I'm fucking things, where I'm missing something, where I'm not respecting my rules. And first, I'm not making money, which is annoying. And second thing is I'm losing confidence in my process and my ability to respect the rules. And again, so that is really true for retail or pros. You need to have a clean process and follow the rules. If we follow this process, we want to be generating IDs after IDs to have a big watch list and possibly a lot of trades on. The last point, and I think this is important, is we mostly lose because we have no risk management. And for me, this is probably the most important thing of managing money. Managing money is managing the risk. So again, I just built the videos. The video series that I just built, the risk management is at the end. Maybe it should be at the start actually, but I've built different videos where I think it is core that if you don't get them, if you don't understand them, you have no chance. Even now, I have some mentees after the mentoring program, 6 months, 12 months, 18 months. They are still struggling with the foundations because they are not listening. And then we have to go through it over again. If you don't have the risk management, it doesn't matter if you're good at idea generation. It doesn't matter if you're lucky, you're going to be losing money. So from experience, when someone with little experience tells me that he's using leverage or has big concentration, I know, as I said before, he will come back to me in the next 6 months asking for help. The second point is following risk management is often seen as boring, not sexy, or as traders, we should be taking massive risks. I think here this is a big misconception. As we have all the cliches of traders driving fancy cars or being on steroids. In reality, successful traders are very reliable machines who have a strong process and a strict risk management. So that's funny. I'll give you an example. Each time we're going for dinner with my wife and people come to me and say, what are you doing as a job? I say, I'm a trader. And they look at me and say, oh yeah, you must be always on steroids, extremely pushy. And they don't understand that actually my wife look at them and say, look, this is a marathon. If you don't have a long-term picture, you stand no chance. Why? Because you are investing against a market that is always evolving. So that is the beauty of investing. It's always changing, so it's very challenging for us. You're always learning if you want to be learning, but that means the parameters are always changing with different volatility, return, liquidity. So here, what we need to have is we need to be flexible and humble, but at the same time, keeping everything under control with a tight risk management. So 3 pillars of risk management. You need to have limited leverage, limited concentration, and a hard stop loss. So those are the basics. There are much more to do. About the leverage. For the ones who just woke up in the US, so thank you for that, you're going to have 2 times leverage if we are talking about stocks. So if you have $10,000, that gives you the ability to get $10,000 long versus $10,000 short. Here, what you should be doing first is limiting your next exposure when you start. So max, don't do more than 20 to 30% net exposure. So that gives you, for a $10,000 book, something like $2,000 to $3,000. For Europe, we need to adjust as we are 4 times leverage. But still, don't do more than 20 to 30% net exposure. So limit your leverage, limit your exposure. Again, I'm talking about stocks. I know the downside of many retail traders. They go trading cryptocurrencies, they go trading FX where they have huge leverage. And this is where they are losing money. Limit your leverage on any of those assets because otherwise you're going to be losing money quickly. I'm going to give you an example here where recently I had someone that contacted me on Twitter and told me, look, Greg, I have those 2 positions, which was, I think one was long put on Deutsche Bank and long put on Daimler. And he said to me, look, Greg, I've been losing a lot of money. I went to this conference call and actually those people advised me to do this. And I put all my money in this. First thing first, do you have a process? Do you get risk management? How do you do things? If you put all your money in something that is leveraged and it doesn't go your way, you're going to lose everything. So if we look at doing options, when we do options, we have to keep in mind that we are buying 2 things. Time decay and volatility. So depending where we are entering the trade, we have different implied volatility and we will have time decay. So if nothing happens, the options will end worthless. So be extremely careful on the risk management, on the leverage you are using. It's not because you're only buying options that it's going to be better. So here, that is the disclaimer with option, looking at implied volatility and the time decay, which is the theta. That is the example for the limited concentration, and that can be true for stocks. So limit your concentration. The third point, which is the hard stop loss. And really the hard stop loss, you can't play around it. This is key. This is something that I intensively talk in my video series. If you don't respect the stop loss, you'll be in trouble for two reasons. The first one is obviously you'll be losing money. So that means you're going to have a margin call or you're going to be wiping out your account. And the second one, trust me, you're going to be completely destroying your confidence. And again, investing, trading, there's a lot into confidence. So quickly, I want to be discussing what is covered in the 4x4 video series, which will be released next week, and in the mentoring. So what I want to be doing with the 4x4 video series is for you to be consistently making money over time. I'm not going to bullshit you. We are not targeting 50, 100, 200% return. What I've been doing over the years is I'm targeting first to do 5 to 15% return. My worst year was in 2017 when I was down 3%. I want you first to be limiting your downside to 5, 10% and be building from there. If we have a great year, let's take it. But be honest, we need to build slowly our track record, our P&L, and our learning curve. We have seen the very successful people in the industry have between 15 to 20% return. So we should be careful on our expectation. So the 4x4 series is top-down process overlaid with bottom-up idea generation, active trading, and special situation. Why? Because over those years, my conviction has always been we need to have a core portfolio which is based on what we think about the world and the market condition. Still, the market conditions and will offer opportunities, so we should be trading them. And we're going to have special situations. So if we look at special situation, that is something that is easier if we have a professional setup. So we need to be realistic about what we can do. What you're going to learn here is to diversify your portfolio across asset classes, FX, bonds, commodities, with a core portfolio around stocks. We want to be, at the end of the process, discussing through different videos about how to optimize our P&L, and as I said, having a strict risk management. It's all about limiting our downside and improving the returns along the learning curve. So that's roughly 40 videos with roughly 30 hours of footage and more than 45 spreadsheets. So why we have those 45 spreadsheets is, again, I want you at the end of the 4x4 video series to be independent and to be building your own infrastructure. So I want you to have the foundations and to be building from there. If you are looking for the mentoring program, I think it's better that you directly contact us on the website. And actually, I should come back to you very quickly, as I think the mentoring program is very helpful and is a great accelerator in your learning curve. So again, 4x4 video series is articulated around why we are failing. So that's something that we touch base today. And so there's a long video, similar on why we are not making money. Then we try to figure out and understanding what is the GDP, what are the components of the GDP. We will then be looking at asset allocation versus the economic cycle. What are the expected returns versus my realized returns? So this is all the points that we discussed today. We're going to spend a lot of time into macro analysis because as an investor, no matter what is your time frame, you need to understand how is the world looking. Then it's about generating ideas through different filterings. And here this is key not to have only one process. We want to be able to benefit from different ways of generating ideas, to build a strong watch list. When we are into the watch list, we have ideas. From our ideas, we want hopefully to be putting trades. And this is why we will have to look through technical analysis, price action, and risk management. Then we'll have the P&L optimization as we want to get better and better. So for more information, you can go into Gregoire Dupont /education. So quickly, as a conclusion, for this video, the webinar, we need three things. We need to have realistic expectations, we need to have a valid process, and we need to follow a strong risk management. On the first point, you do not have to lose money first to win later. So this is not necessarily the way you should be working. Think about this learning curve in front of you and that it takes time. Again, even if it sounds a bit cliche and boring, this is not a sprint. So don't worry, it will never be, in fact, a boring marathon, as the market is always moving, and as long as you're keen on learning, you will be good. The second point is think that yes, you can be learning on your own, but very often it is best to get help from real pros. Third point, always have a strong risk management as it will save you from possible bad times. Limit your downside to 5 to 10% losses on a single position, on months, or from the top. If you build from there, I'm sure you're going to be successful in the future. So again, thank you to all of you who listen from all over the world today. I hope to see you soon and be able to help you in the near future. I'm always happy to answer your questions, so you can find me on Twitter, on the website, on Facebook. So please get in touch with me. For those in Asia and Australia, good night. In Europe, good afternoon. And the ones in America, good morning to you. Thank you. See you soon.